Let me try this. Hello? And we're back. Okay, I don't know if someone can hear me here. There was someone here who was asking me, where's the VC stage? So the next one, no? I'm good to go? Okay, so the next talk that we have is about capital markets, and it's led by Beto from Off-Chain Labs. Beto, if you could come around. And he's doing it without the slides, so pay attention, folks.
Hey everyone, yeah, we're doing this live. So yeah, thank you for that introduction. My name is Beto. I do strategic finance at Off-Chain Labs. We are a technology infrastructure provider and the creators of Arbitrum. And as part of my role, I also lead the investment arm of Off-Chain. We go by tandem. So we are active participants in the capital formation process. And what we're seeing as investors is that now the bar is being raised. And that's probably why a lot of you probably felt that it's harder now to raise capital than it was a couple of years ago. And in my opinion, this is not just a crisis, it is just capital markets in action. Because this is not the end of funding, of course, but we believe it's the end of easy funding, which is a different thing. Because let's be honest, back in the day, if you had a white paper, a roadmap, and some traction on your socials, you were good to raise. You could go get a deal, and it wasn't that hard. And in my experience, I don't think this was completely irrational, as you may think. This was more because the macro was there for that. Interest rates were super low, liquidity was everywhere, and money in general was cheap. So investors tend to relax when that happens. And we saw this happening multiple times in the past with Wall Street, with the tech industry, and also, of course, with crypto. How did Wall Street respond to that? Well, they took immense levels of risk when capital was super cheap. What happened with the tech industry? Well, they, or prioritize growth instead of profits. And what happened with crypto? Well, we decided that we wanted to accelerate everything, and we dump a lot of money on it. And again, when capital is abundant, discipline relaxes. Narratives get rewarded, speed gets rewarded, but fundamentals get deferred. And I think that is the critical portion of this, is that when money is easy to get, fundamentals are hidden. Like, people don't pay attention, nobody double checks, nobody asks the next question. And in my opinion, that era is over, because macro is here again, and capital has cost again. We've seen that there is steady higher interest rates. We see that there is presumably tighter monetary policy. We see that with institutional adoption, definitely a great theme, but that also meant higher correlation with other assets. And this all translates into the risk being repriced. And I don't think crypto was singled out in this new paradigm, because we've seen similar situation in other growth asset classes. And it just happens that there's a reset when the geopolitical influence and dynamics turn the other way, and capital becomes more selective. So what I expect to see investors making fewer bets. I expect to see longer due diligence processes, and I just expect to see higher standards. And as investors, that is what we are actually doing. We're taking our time. We are speaking with more teams, but filtering most of them. And it's not that it's an anti-crypto perspective or stance. This is just making sure that the healthy capital markets are correcting and that we are ready for that. And the way I kind of see these translating into the fundraising process and capital formation is that narratives are not longer enough, right? So um, for a long time, I believe that narratives were driving capital formation and funding. Everybody was talking about like decentralization, community, the future of finance, and all that, which are great ideas, but people were not thinking about how to turn that into an actual product that people will actually perceive value and will obtain value in the end and will use. So, in my mind, ideas now are not sufficient. Narratives are seed tools, but not underwriting tools, and this is an underwriting market. I think like incentives definitely can create, um, a first adoption and attention and activity, but they won't create retention. And attention doesn't mean demand. And community definitely powerful, but that doesn't mean customers. And customers in the end are the ones who pay. So, it's interesting because what I've seen from talking with other, investors in the industry is, what are you guys thinking about now? What the questions are you trying to solve? And the main one is, does anyone use this product? Are people going to stay after the first round? Because I feel like overall the view has changed from how big could this be to how fragile is this? What's going to happen when incentives are not there anymore? Because in my view, I feel that narratives will definitely get you the meetings and open a lot of doors, but in the end, numbers will get you the checks. So what does this mean in the current process for founders and investors? It means that PMF is back and is back in a big time. It is not a milestone anymore. It is not something that is nice to have and that people were paying some attention but actually not double checking. Now is the ticket of admission to the game. If you want to come and have a serious conversation, you need to have strong evidence of PMF. And I don't mean perfection or guaranteeing scalability or having the most optimal tokenomic structure. I'm talking more about being able to prove that real users will stay after they stop being subsidized by the protocols. Because as investors, we don't see PMF as upside anymore. We actually see it as downside protection. What is going to happen after everybody who was farming these, everybody who was just here for the short-term incentives are not longer. And, in this market, capital doesn't reward the possibility of something happening. Capital will reward evidence. And in this marketing, retention that survives incentives is the evidence. And in my opinion, that shift is going to shape the next cycle for capital formation. Okay, so that was a lot of bad news in general, and really hard things that are in the horizon. But here are the good news. The good news is that we are evolving as an industry, and I've been as an investor for over 10 years now, and I'm sure a lot of you have gone through multiple cycles, because macro will be easy money again, there's going to be a bonanza again, so these things will repeat. So in my mind, this is not that we are doomed and let's close and let's go. This is more about, it's going to be harder for founders. If you're looking to raise money, there are going to be more questions, but at the same time, it's going to be more equitable. You are going to not need to be the loudest person in the room, have the highest hype, or biggest numbers in gross numbers. This is going to be more about, do you have something that actually works? Because for investors, this means discipline. This means backing for your projects for sure, but with stronger fundamentals, with long-term alignment. And that is the view that we have at Tandem at Off-Chain Labs, because what we try to do here is we support our partners all the way from purely writing a check to them to deploying resources, engineering, research, and all that. And we definitely try to find those projects that align with our long vision of the whole ecosystem. People that can contribute to the roadmap, not only the roadmap that we have as a company, but the roadmap that we think we have at a higher level as an industry. And in my view, this is how durable ecosystems are built, because easy money is gone now, but serious money like us are still here, are still looking for good opportunities, and serious money builds serious companies. And in my opinion, that is the path that we're going to take in this next cycle. So, yeah, again, apologies for not having the beautiful slides, but it's been my pleasure. Thank you very much, and I'll be around if you have any additional questions. Thank you.